In this week's Global Economic Week ahead, all eyes are still on the U.S. government shutdown. We'll also be sifting through key central bank meeting minutes and Fed official comments for crucial monetary policy insights. And joining us for a look ahead is Jameel Ahmad, chief analyst at online trading brokerage GTC. Thank you so much for your time, Jameel. Now, as I'm talking about that U.S. shutdown, it's now entered its second week. I understand the market's shrugging off maybe a few days of the shutdown, but now we are looking at a second week, quite prolonged. What is happening here that the markets are they're just not worried about it?
I think financial markets are taking with a pinch of salt towards the direction that the longer that this shutdown continues, the worse the impact it will have on the US economy, and the more likely the likelihood that the Federal Reserve will need to cut US interest rates at a faster pace than what current Fed officials are, stating that they're willing to do. Generally, though, with government shutdowns, again, this is nothing new. We've seen so many government shutdowns over the past couple of years, to be honest with you. But the concern here is that it's going to be used as a reason for the Trump administration to cut more federal jobs. So this is why they're looking at more of I would say, a direct economic impact. Whereas before, with government shutdowns, you generally saw that once the bureaucracy had settled, that economic activity then just picked up again in the following quarter or the following period and so forth. But this time it does seem to be a little bit different. And I think that the worse the impact it has on the US economy, and specifically if it is going to be correct that jobs are going to be cut as well, then that does really put more of the pressure on the Federal Reserve. And we've been speaking for months now that pressure cooker it's boiling.
Exactly. And just on that, we talk about jobs, we talk about the Fed. Of course, we're supposed to have the non-farm payrolls out last week, Friday. That did not happen. What do we have now to go by in terms of getting insights of monetary policy and the future of it?
Not much when you consider that how critical that Federal Reserve jobs report would have been towards the upcoming Federal Reserve decision in a couple of weeks. And again, we have had NFPs be cancelled before or postponed. But the last time was 12 years ago, during the Obama administration in 2013. Of course, we're in a completely different financial market environment now. And the concern is that clearly there's a standoff in Washington. And there's every possibility that this shutdown might continue far into October. Nobody's actually optimistic it's going to end anytime soon. And that also means that other key economic data metrics will be missing before the Federal Reserve meets. More specifically, that US inflation reading that's due out at the end of next trading week. So this really puts a lot of difficulties on the Fed. Of course, as it did appear from the Senate Commission last week, that NFP number is known by the Trump administration. So it's likely to be known by the Federal Reserve, but it's not official, it's not public knowledge. So what the Fed can do and how they can act on it, I'm not sure. But I do think the Fed needs to be more aggressive because the wheels are turning towards a direction that US interest rates are not coming down soon enough, even though that's not their fault because of all of the uncertainty the Trump administration encouraged with the tariffs and so forth. But nonetheless, we are seeing some downturn in economic data, specifically with jobs. Jobs are critical to the US economy because consumer spending is the cornerstone of the US economy, is the #1 contributor of US GDP. So I do think the Fed might need to cut. If they're not going to cut in October, we're going to look at a bigger cut before the end of the year. And it's just whether they really want to back themselves into that corner.
All right. Well, very, very interesting developments out in Japan. Of course, we did have Japan's ruling party selecting Sanae Takaichi as its new leader, of course, being poised to be the next prime minister, first female prime minister. But I did notice the yen weakening. What's going on there with market reaction to these news?
So as we've seen in the past, it's the same with the German DAX and the euro. There's an adverse relationship with the Japanese yen and Japanese financial markets, specifically the Nikkei. Yeah. The Nikkei rallied around 4 to 5% during the early hours of trading this week. And that then encouraged a significant spiral lower in the Japanese yen. But she is seen as somewhat of a market-friendly appointment. And that's why there's concerns that the Japanese yen might be on another turn for weakness, because 150 is a very big psychological level. And I have to give you guys a secret. The Japanese yen is the most oversold currency in the foreign exchange world. So when we're looking for a currency to make a comeback, and maybe it's a bit too early to talk about 2026 expectations, Japanese yen is definitely my leading contender.
All right. Well, just lastly, before we let you go, Jameel, as we were talking about monetary policy, the ECB is set to release minutes from its last meeting. I think if I remember correctly, after being on a roll in terms of interest rate cuts, they've actually paused on that. So what are we expecting from the central bank?
I think European Central Bank officials are quite unanimous that they've cut interest rates as aggressively as they can over the past 18 months since the beginning of 2024. They've gone way above half a dozen interest rate cuts. So it's about now looking to see whether those interest rate cuts are going to help the economic activity of the European Union. Of course, global factors such as the trade tensions, the trade tariffs, and other forces are not supporting matters. But I think what the the elephant in the room really hopes to see is that if we have an easing of that conflict of Eastern Europe, then that's going to be very supportive of economic activity. But of course, the ECB officials won't put that out there. But if we did have an easing between that Russia and Ukraine crisis now that's gone past 3 years, then that's going to be more important than the stimulus from the European Central Bank. So those interest rate cuts are helpful, but what would be really helpful is a more positive and stable global economic environment.
Indeed. Well, thank you so much for your time and giving us insights on what to expect this week. That was Jameel Ahmad, Chief Analyst at online trading brokerage GTC, with a global economic week ahead.